Hi, my name is Joel Hooper, and today I'm going to be talking a little bit about the Energy Corp and the current valuation of their stock. So let's get started. Question 1 asks us to find the nominal expected rate of return as well as the effective annual rate of return for Energy Corp. So what we do is we take the $100 par value of the stock, multiply that by the 9.75 cumulative dividend, and you divide that by the current value of the stock, and that lands us at 9%. From there, we take that 9% and we can get the effective annual rate of return by simply plugging that in there. These two fours are going to be our quarterly dividends that are paid out, and that lands us at a 9.31% effective annual rate of return. Part B of the question asks us to find the value per share using a required rate of return of 8%. Well, using the present value function in Excel, we can plug in the 8% nominal rate, the current year, the cumulative dividend, and the payout, and find the present value for each year effectively to be $104.41 value per share. Our second question wants us to find the expected rate of return at the beginning of 2003 for Energy Corp, as well as the expected dividend yield and expected capital gains yield. First, you're going to want to find the expected dividend yield by plugging in your $1.80 in dividends, divide that by your stock price, and that gets you an 8.09% expected dividend yield. You can simply plug that 8.09% into the expected rate of return plus your growth rate of 6%, and that lands you at 14.09% expected rate of return. Lastly, we're going to want to find our expected capital gains yield. We do so by plugging in the stock price here, adding in our growth rate, adding the stock price, and dividing the stock price, and we land at 6% expected capital gains yield. As the growth remains unchanged, both the dividend yield and capital gains yield will continue to be the same as well. Our third question asks us, if we're using the Gordon model, what conditions must hold true? Well, using the Gordon model to determine the value of a stock, we need the following constants: dividends per share, dividend growth rate growing constantly, and a constant expected dividend as well as a capital gains yield. However, in the real world, these numbers are always adapting and changing, so this model can be very tricky to use. Our fourth question asked us, what was Energy Corp's stock value on January 1st, 2003, assuming a 6% dividend growth rate for 5 years, and after that a 7.5% historical 10-year growth rate? Well, using Excel, we were able to determine a present value of $28.56. Our fifth question asks us to find the expected stock price at the end of 2003 or beginning of 2004, assuming the stock is in equilibrium. Using the same exact function, previous question, we are able to find the expected stock price of $30.62, which, as you can see, has grown over the year. Question number 6 wants us to find what the expected dividend yield, capital gains yield, and total return was for all of 2003. Well, simply to find the expected dividend yield, you take the $1.80 dividend that was paid, and you divide that by the expected stock price of $28.56 in 2003, and you get 6.30%. In order to find the capital gains yield for this year, you take the expected stock price at the beginning of 2004 of $30.62, subtract the expected stock price of 2003 of $28.56, and you divide that by that same $28.56, and that lands you at 7.22%. Now, the big question is, what's my total return? The total return is simply adding these two numbers up and lands you at 13.52%. Question number 7 asks us, if Energy Corp's dividend yield is expected to remain at a constant $1.80 for the next 5 years, then grow at a constant 6%, if the required rate of return is 13.5%, is Energy Corp's stock value higher or lower than in the previous problem? Well, in the previous problem, we found the stock value to be at $28.56. However, after using this $1.80 dividend constantly for the next 5 years, and then the 6% growth rate after that, we found a dollar value of 19 per share. The eighth question asks us, if we are using the growth rates from the introduction, what is the stock's expected rate of return? Well, using Excel, we were able to find a 43.71% expected rate of return in 2003, simply using the dividend yields and capital gain yields from 2003. Our ninth question says, is the assumed growth rate of 6% reasonable? And what has the trend been? Well, I would say yes, 6% is reasonable as the trend has been upward. Our 10th and final question asks us, can the Value Align's return on equity for 05 to 07 be used to estimate a long-run sustainable growth rate? And does this figure support a 7.5% growth rate? The answer in short is yes. If you take the required rate of return and you subtract the 6% current growth, you will land at 7.5%.